process of giving a further update to sort of a more quarterly style presentation that will be released to the market. And I guess also I felt it was important, just off the back of the announcement that we made a week or so ago in relation to the sale of National Australia Bank's interest in Metrics Credit Partners, and the change in ownership there with Pinnacle joining our register as a shareholder. So Pinnacle have acquired a 35% equity interest in a company called Metrics Credit Holdings, which in turn owns 100% of Metrics Credit Partners. So we've had a long-term relationship with Pinnacle now over the last 5 years. They've assisted us around capital markets distribution and third-party capital raising. So from that perspective, we know them well, and their relationship will be continuing on with us. I guess in terms of MXT specifically, the performance of the fund is going very well. We obviously raised the initial $515 million in October of last year, with a further $212 million raised in March, April of this year, taking that fund to around about $727 million. All that capital is deployed across 82 individual loan assets. As at the end of June, the running yield on that portfolio was 4.94%, which is again ahead of the target that we had at the time of the IPO. So when we listed, we said we would deliver a minimum net return to an investor of the RBA cash rate plus 3.25 net in the hands of the investor. We've delivered and exceeded on that. And importantly, the portfolio diversification has also continued to track in line with our expectations. When we first launched the fund, we said we would give investors exposure to not less than 50 assets, I think it was, moving to a medium-term target of up to 100. As at the end of June, inside the 12-month period, we're sitting on 82 individual loan assets. No credit losses. The portfolio is performing very well. Each of the individual loans, they're all performing. There are no arrears. There's no interest arrears. There's no covenant defaults. There's no issues in terms of any of the assets that we hold. I guess in terms of where we sort of see things at the moment, obviously there's a continuing scarcity of capital available in the real estate sector as the banks have withdrawn from that part of the market, particularly very difficult to obtain funding. Really what's occurring now is sales rates or pre-sale levels start to slow. It's becoming very difficult for those that don't have the required level of pre-sales to get particularly residential apartment developments in Sydney, Brisbane and Melbourne, if they can't achieve those pre-sale targets to fully fund and provide for debt cover prior to commencement of the construction, those projects just won't get off the ground. And so what we're sort of seeing is still a continuing slowdown in terms of pre-sale levels, and that I think will fall to a position where those that have weak marketing programs or a weak product in a weak location, those products and projects may not see their way clear to market. Somebody was asking, one of the questions I had from Steve Wright was asking a little bit of granular detail around our larger exposures. We have probably a few exposures that are around about 1.8, 1.9% of the total book. And they are the larger exposures that we have is to Ramsay Healthcare, to Caltex. We have a $75 million exposure to Ramsay Healthcare. We have a $75 million exposure to Caltex. And we have an $85 million exposure to the Abbott Point Port operated by Adani. And so across those three, they're the three larger exposures that we have in the portfolio, but we continue to build out diversification. When I think about aggregated exposures, some aggregated exposures to property groups might exceed a single large exposure, but again, they're all subject to individual assessment around the security levels and the cash flows for those individual projects. As what I mean by that is you may fund a particular development group across 3 or 4 projects, and they aggregate to a higher level than 85 million. But on each individual project, you might be exposed to, say, an LVR of sub 50%. But on an aggregated basis, it might exceed that. But where we do that, those financings are all in SPV structures. I think importantly too, one of the benefits that we saw with MXT when we brought that product to market was we were definitely trying to deliver a very stable asset value to investors. The underlying loan assets are very stable. They're all floating rate notes, short dated instruments, and we see that churn and the way in which we manage the book as being very important for investors, in that it really does, in our view, reduce the credit risk our investors are exposed to, reduces the market volatility that they're exposed to, and provides for ongoing regular repayments at par. And that's been our experience. So since we set up our first fund in June of 13, we've completed well over in excess of $4.5 billion. Over 172 individual loan assets have been completed. We've not delivered an inconsistent. We've delivered consistently for our investors month in, month out. And importantly, that trend is expected to continue. With MXT, we obviously see, as we've raised additional capital, the opportunity for investors to see increased levels of liquidity. And pleasingly, with that particular entity on the exchange, it's continued to trade at a premium to NAV, both the issue price and also for those that came in the entitlement offer. And not only did they receive their full distribution as at the end of April, but they've also seen ongoing value above the issue price. So I think it's been an attractive short-term position anyway for investors in our stock. Thank you.